Hi there, and welcome to this video on fundamental analysis. So in this video we're going to be talking about fundamental analysis, what it is, and how you can use it to come up with trade ideas. So first of all, let's have a look at what fundamental analysis is. Well, it's the use of financial data, economic information and other impactful information to determine the value of a security and its future price level. And generally this can be broken down into two areas: economic news releases and economic news flow. So if we look at those two areas in more detail, first of all, economic news flow. Now, these are unscheduled events that affect the markets, and it could be anything really, but effectively it's stuff that's going on in the world. Now that's why it's important as a trader to be really tuned into what is going on in the world by watching the news, reading the papers, maybe having a look at websites such as Bloomberg, Reuters, to keep yourself up to date with things that are happening in the world, which will therefore have a knock-on effect to the markets. Now, just to give some examples of some of these major broad picture events that happen in the world that can affect the markets, something like unscheduled central bank announcements or unscheduled company announcements can have a big impact on the price of assets. If you look back to January 2015, if you would have been trading any of the Swiss currency pairs, you would have been in for an interesting time. Previously, the Swiss National Bank had said that every time the price of the euro against the Swiss franc gets to 120, we're going to buy more euros, because it's not favourable for our economy to have the price of the euro against the Swiss franc lower than 120. However, they couldn't afford to carry on buying euros every time the price got to that level, so they said, right, well, we're going to remove that floor in the currency pair. And as a result, the price of the euro against the Swiss franc sold off massively. And because they had previously said about this floor in the currency, a lot of traders have put buy orders in the market at that level, and if you had been long the market on that day, you would have been caught out big time. So that's just one example of a central bank making an announcement that's unexpected and the effect it can have on the market. If you look at maybe Volkswagen and the emission scandal that's happened fairly recently, where Volkswagen manipulated the results of their emissions tests on their cars, this had a big effect on the price of their stock and also on other automobile manufacturers. So that's another example of something that's unscheduled, that's not expected, that can really have an impact on the market. Natural disasters and severe weather conditions can influence the price of, in particular, commodities. If you think of something like coffee, for example, and then you think of the areas of the world where coffee is produced, particularly South America, let's just say, hypothetically speaking, that there was a sustained wet period over in Brazil where they make a lot of coffee, and that affected, because it was so wet, it affected the harvest of coffee. Now that would therefore mean that there's less supply of coffee to the market, and therefore if there's less supply, more demand, you'd expect the price of coffee to go up. Something like a disease outbreak. When I say disease outbreak, I don't mean on a small scale, I mean some sort of really mass disease outbreak that effectively the disease can be spread cross-border, something maybe like Ebola that happened in recent time, where it can cause panic in the markets, and there's one thing that the markets don't like, and that's uncertainty. Unfortunately, terrorist attacks seem to be a fairly regular occurrence these days, and they can have a big effect on the markets. If you think about when you had the attacks on Paris recently, immediately after those attacks, the equity markets in particular sold off quite aggressively, and they were very volatile in the next few days after that. War and conflicts. In the current climate, there's heightened tension over in the Middle East, in particular Syria and this causes again uncertainty in the markets, and essentially because of this heightened tension, again it causes uncertainty. And what traders tend to do in times of uncertainty is they take their money out of riskier assets and they put it into safe havens, as they're called, such as gold, such as US treasuries, such as currencies like the Japanese yen. And of course this affects the flow of money in the markets, and therefore you need to be aware of this stuff so you can understand where people are looking to put their money. Finally, political elections can have a big impact on the market. If you think of when the UK elections were happening last year, the pound was very volatile going into those elections, particularly when it's uncertain around who's going to win that election. It can be even more volatile. So the Labour Party and the Conservative Party, and we weren't sure who was going to win the election, and the pound was very volatile in the month leading up to that election. So really, economic news flow is anything that can influence traders' opinions about the markets on a daily basis. The next area is economic news releases. These are scheduled on an economic calendar, so you can look at your economic calendar at the start of every day and you can see what news and data releases are due to happen on that day. And it's really useful because you can therefore start to build up a picture and a plan of when the market could be more volatile, and you can therefore use that to your advantage. Now, generally speaking, it's the medium and high risk events which will have more of an impact on the market, and your economic calendar will tell you whether the news release is low importance, medium importance or high importance. There's lots of events and data releases on a daily basis, and some of the key ones to look out for are things such as central bank interest rate decisions or central bank meetings, central bank governors or presidents speaking, or other members of central banks speaking, because traders are listening to the words that they're saying, and that can move the markets. Other economic data releases such as gross domestic product, consumer price index, producer price index, retail sales can all give you an indication as to the strength of that economy. And also, finally, job data is very important. So in particular, non-farm payrolls, which is released out of the US on the first Friday of every month, and other employment data is going to have an effect on the markets, because traders are looking at these data releases to form an opinion about the strength of that asset that they're trading. Broadly speaking, if the news comes out, the news release comes out and it's better than it's expected, you can expect the price of that asset, the asset that it affects, to go up immediately after the news. Vice versa, if the news comes out and it's worse than it's expected, you can expect the price of the asset that it affects to depreciate immediately after the news. So there's a number of economic calendars out there, and yours might look slightly different to this one. However, they'll all show you certain information. Looking at this screenshot that I've taken of the economic calendar here, the first column shows you the date that it relates to. It then tells you the time that the news release is coming out. Then it tells you which currency or asset that could affect, and it tells you the impact. So anything red is high importance, anything orange is medium importance, and anything yellow is low importance. So generally I kind of look over the yellow ones and then look straight for the medium and high importance news events. It will then tell you exactly what that news event is, and if you're not sure what any of these things mean, you've got a description here, so you can click on the box and it will bring you down a drop down description, and it will tell you exactly what that news release is. Then it will tell you, after the news has happened, what the actual data came out as, and it will also tell you what it's forecast to be and what it previously was. Now this can be useful information because it means we can start to build a plan around these news events. What we can do is we can have a look at it. Let's say for the pound at 9:30 we've got manufacturing production month on month being released. Now it's forecast to come out at 0.4%. Now what we can do is we can look back at other UK data and see how strong that was. If going into the news other UK data had been lower than expected, then we could use that to our advantage. We can say, okay, right, it's forecast to come out at 0.4%. Going into this news, other UK data has been worse than expected. Therefore, maybe this number is going to be weak as well. We'll sell the pound going into that news event. Vice versa, if before the news event other UK data had been strong, better than expected, we could be saying, right, well, other UK data has been coming out really strong, maybe this number will be a decent number too. We'll buy the pound going into the news event. That's just one example of how you could trade it. You could wait for the news to come out, and immediately after the news, if it's worse, you'd expect the price of the pound to sell off, and if immediately after the news the data's better, you'd expect the price of the pound to go up. So I hope that gives you some food for thought in terms of how you can start to use fundamental analysis in your trading. Of course, if you have any questions about this or need any additional support, please do get in touch with your account manager here at STX Markets in London. That's it from me for now. Stay safe in the markets, and I'll speak to you soon.